Hey, now that's what I'm talking about. That's the music right there, huh? Wait. What am I hearing now? Oh, yeah. Oh. That's where it's at right there. Hey, welcome to the Closing Beat, everybody. Happy Thursday. How you doing today? Hope all is good out there. Thanks for watching and joining us here. We talk about the stock market in a different way. We like using data. Your opinion about where a stock is going to go is probably just as good as mine, but I like using data to show where money's moving, what people are interested in, and we do that a lot here at Jazz Wealth. We're long-term, sort of retirement-based investors, and we do the same thing. We focus on data for that and manage our own funds so there's no expense ratios and all that garbage that's out there. That's actually my background, so I enjoy doing that. So thanks for joining us here today. It's going to be a marathon or sprint kind of a show today because I got to get out of here. There'll be no wine and wealth tonight. I do have to take my wife to the airport as she's traveling across the country, and she doesn't travel by herself, so she's a little worked up about it. And so I want to make sure all that goes well. So let's get started here. Go over there. That's a brutal day, huh? Now, the market being down, let's say the S&P down 1.5%, not really that, we've seen that. It's that type of market right now where we have these big up and down days. But it was brutal out there today. I want to show you something real quick. If you look intraday, let's go to like a 5-minute chart. Look at that. That is strong, consistent selling all day. We had gap up today. Hey, looking good. Following through from yesterday. Everybody's excited. Little pullback. You go, it's not bad. Okay, I can live with a little pullback. And then just punch after punch after punch all day long. Every bounce was a failure, right? So if you're a day trader that's like, gap up, we got a little pullback, I'm going to buy that, failed. Next bounce off of this prior support, it failed. All the way back down to prior lows, failed, right? Just a random bounce out of nowhere because it's the 215 or 115 reversal time, failed. Everything failed right to the end of the day. So that makes it really brutal. And if you look around the market, everything kind of continued to really take a hit today. And so I'll continue to say the same thing that I have been saying. Is there any good reason to invest heavily here? If you're a new investor, you're all excited, if you're going to dollar cost average, that's awesome. You're actually getting a little discount here. But is there a reason, any good reason for you to aggressively buy stocks as a whole, build a portfolio, throw a lump sum into the stock market? Be very careful because I don't see any real reason to do that. So you got a power trend lower here today. You would suspect that momentum carries into tomorrow, especially being a Friday. You have people going, I see that. I see how weak that was. And even if tomorrow's higher, do I want to bet that tomorrow reverses all of today? That would be very abnormal. And so you likely see like a choppy kind of a day tomorrow, almost uneventful if you think about that. The S&P is now down about 8% year to date. And guess what held up again today? Guess what held up? And it was negative. It was down on the day. Every sector was lower on the day, but consumer staples, best performing out of all of them. Now it's very extended. You would expect to see profit taking here, but no, it was once again the strongest sector, even though it was down. It was one of only two sectors that was down less than 1%. Every other sector in the market, you got consumer discretionary, industrials, healthcare, financials, materials, utilities, technology, communication services, and energy were all down more than 1%. If you look around the stock market here today, we're looking for the worst things. The biggest of the worst was Amazon. Of course, Facebook was lower on the day. These are the bigger stocks, right? That have a lot more weighting. Microsoft was lower on the day. Apple lower on the day. Not Tesla, though. Tesla higher after earnings. It did give back quite a bit of its gains throughout the day, but you almost give it a pass because earnings were great. There's almost nothing to complain about with Tesla as far as how they performed fundamentally, but the stock market was incredibly weak, and so that broad selling kind of took away a little of the excitement from the earnings from Tesla there. You got all kinds of different stocks in semiconductors hitting new lows. NVIDIA breaking down there. Micron Technologies about to break down. Qualcomm, there you go, just about ready to break down in consistent downtrends here. Really, really weak. AMD lower as well. That hit new lows. What held up? Consumer staples, right? The boring stuff. Oh, there you go. Philip Morris. Hey, nice and strong today. Here's how you had 2%, right? What's the other one? Altria, the cigarette, tobacco people. all higher on the day. I've been picking on Colgate. Just kind of funny that it's Colgate. They make toothpaste and some other stuff. Colgate, right? Really strong and has been strong, so that continues. The grocers, Kroger got a little bit of a bounce on the day. It was very hard to find stuff that was strong that you could get excited about. AT&T had earnings that came out. We'll cover in a little bit there. That helped Verizon a little bit, and but really, really tough day all across the stock market. Now, that's something we haven't seen in about a week and a half, so that's where you kind of come back to the market and go, ooh, that's considerably weaker than I was expecting there, right? Now, let's talk about something here. Which areas in the stock market are performing the best, not based on sector, but based on the type of stock? Occasionally what we do is we look at the stock market and say, are the higher price stocks doing well? Are stocks with higher PE ratios doing better than those with lower PE ratios? All the fundamental scans, and we break the market into little chunks. So I want to share that with you here today. And I'll just show you a couple things that I thought was interesting. Let's go over here. You've got the stocks with the lowest to highest share price, right? That's the performance. So far for the month of April, stocks with the lowest share price have performed the worst. Average loss of 4%, right? Those with, as you work your way towards higher share prices, they haven't done much better either. And so what you have is the beaten down stocks over here continue to get beaten down. Excuse me. And the stocks that are higher priced in the growth category, they're also selling off. So that's a weak spot. You don't want to be looking on either end of that spectrum. If we go down to the size of the company, market cap, stocks with the lowest market cap, right? Start getting into the Russell 2000. They're the ones that are performing the worst. The lowest or smallest companies out there have lost so far 2.59% on average through the month of April. As you work your way towards the higher, larger market cap stocks, not so bad, all right? Everything's a little bit weak, but some of these ultra-high market cap stocks haven't lost all that much compared to the smaller stocks. So right now, smaller companies are performing a little bit worse. That's the answer, right? Going from highest dividend to no dividend. This kind of relates to my consumer staples argument that I've been making. If they're paying a dividend, they're performing all right, right? People are chasing almost anything and everything with a dividend, but the second they stop paying dividends, stocks that have no dividends, otherwise known as growth stocks, they're performing poorly, right? And that might be a given. You could probably understand that. What I found interesting was stocks with the lowest international sales, meaning they go sell overseas. The lowest ones would be those that sell the majority of their product here in the United States. They may have some sales overseas, all the way to the stocks that have the majority of their sales overseas and have very little here in the U.S. Anything overseas is getting crushed right now. So if you have a company, take semiconductors, for example. A lot of their sales are actually done overseas. They recognize those revenues overseas, I should say. And so those are the ones getting crushed right now. Companies that are primarily selling stocks or selling their products, whatever, widgets, services, whatever, here in the States are performing a little bit better. So that has to be a consideration that you look at. That's just a fun way of looking at it that I thought I would go through and share with you. Hope you found that interesting. All right, so let's go back over here. The Nasdaq, I want to cover that real quick. After already being down more than 5% in April alone and 16% off of its highs, these highs right here, we're down another 2% today, right? That is brutal. Nasdaq stocks in general, very, very brutal. If I were to take a quick look, you're going to find biotech and the beaten down stocks continuing to be beaten down. Match.com's a great one getting extended here. Obviously, that's not no bueno right there, right? Looks bad. Chinese stocks, growth stocks, companies that have no profits, that are still public. You got Lucid making new lows. Facebook being one of the bigger tech stocks making new lows. Nobody wants to mess with that. And semiconductors like NVIDIA, which I've already talked about there. Really tough areas here in the NASDAQ, all just beaten down the entire NASDAQ there. So something to point out. I want to look at oil real quick. So it was a little bit higher here today, but energy stocks finally take a break. The strongest strongest sector in the S&P right now can take a break every now and then, right? So a bigger decline here, a lot of profit taking as it pulls back. I want to point out that a lot of it comes from the bigger names, Chevron being one of them. This is a position I've had in the office trades. I'm super excited to see this one fall today. I think it was my biggest performer today. Been short this one for a while. You get a big move to the downside here, which obviously brings down energy and brings a smile to my face. If you're part of our office trades people. Also, tomorrow I will do a raw office trades. It may not be the typical one. I guess I'll be here. Yeah, never mind. It's going to be the same thing. Anyways, so you've got oil still a little bit higher on the day. What's going on with oil? We see the biggest weekly drawdown since before COVID, and I believe I have a way to show you that. Here you go. So here's we call them crude oil stocks, stockpiles of crude oil. Over here we're looking back 5 years. Over here is the biggest weekly drawdown since before COVID. You got to go all the way back over here to see a weekly drawdown right there, bigger than we've seen right here, just over 1 week. Right? I mean, obviously there's bigger pullbacks, but over 1 week, biggest drawdown we've seen there. And you go, great. Isn't that good news, right? We're using the oil. We're out there moving around. We're flying on planes and all that. Not so fast. It's actually a little bit worse than that because oil exports have just hit a new high. In fact, if you look at oil exports here, it was the second highest reading ever and now hitting new highs for oil. So we're drawing down the oil, then we're sending it everywhere else, not here. Look at, if you look back as far as we can look, back into the 80s here, it's the most oil we've ever exported ever in the history of the data that I have available to you. Does that make sense? I know a lot of us oversimplify it and say, well, why aren't we using it here? Our gas prices are high. We can convert that into all kinds of great stuff, refine it, and have lower gas prices. Nope. We're just going to send it overseas there, 10.6 million barrels. Very, very kind of poor to see that. Anyways, that's what you have going on there. And what else do I have for you? Let's look at something here. So I got a little fun housing data for you real quick. U.S. existing home sales. They're weak. They're getting weaker, understandably, right? Existing home sales come in, as you can see on the screen there, 5.77 million. June, we saw 6.49 million just before rates spiked. So why did they go down? Rates are higher there. Mortgage applications, originations and refinancing have actually fallen as well. If I plot all of them on the chart, you could see pullback in that mortgage space. No surprise, nobody's interested in claiming that they didn't know that was going to happen there. Now, inventories are actually up. So let me go back over here real quick and show you. Existing home inventory is up about 4%. Single family homes about 5%. You go, well, that's small potatoes, right? It's a little bit of good news, right? For people that got to go buy houses, there's still people shopping out there, of course. So if there is any good news, that's what you have. Now, historically, home prices lag inventories. So home prices are still quite high. The median home price is pushing $400,000 here, and so up 18% just in March alone. So if you're on Zillow and you're looking at your property and, oh my God, look at all this value we've got here. Well, now you know it's starting to slow down there. What's interesting and the fun data that I'm going to share with you is, I got some notes here. The cost to cover a mortgage by hours worked. How many hours do you have to work before you can pay your mortgage? Let's compare that to history. So we're back to 2007 levels. I'm not kidding about that, right? So the number of hours worked, you need to work 62 hours if you are a normal, everyday person. In other words, how it's worded, if you want to look it up, is non-supervisory positions or non-managerial positions. You've got to work 62 hours to cover your mortgage payment. So you work a week and a half, basically, to pay for your mortgage. Do you think that's good? Or is that bad? Couldn't know, right? How does that compare to history? If you put 20% down when you bought your house, right now you'd need to work 49 hours in order to afford a mortgage there. The record was actually in 1980 where a 20% down payment meant that you had to work 96 hours to cover your mortgage. If you put 5% down, if you were able to do that, you'd have to work 118 hours, 3 weeks. Full-time average person there's basically got to work 3 weeks. The average since 1971 is that you'd have to work 60 hours if you put 20% down. That's a little, so we're still looking good, right? So wages are still going up. They're just not keeping up fast enough, but we're still at a point where, all right, if you put 20% down right now, you got to work, 49 hours, but the average is 60. So it's not horrible right there. The average is, if you put 5% down, is 75 hours, right? So I just said wages are going up, but clearly they're not going up fast enough, right? In the 80s, now, here's a little fun point. In the 80s, if you wanted to put 20% down on a property, you had to work 2,150 hours to have that 20%, right? Assuming a 10% savings rate. That's, again, non-managerial roles. At this point, you have to work 2,700 hours to achieve the same 20% down. So even though wages are going up, you have to work so many more hours, 550 more hours here, just to have 20% down. That's a record going back to just before the '08 housing crash there. So not good. We need wages to go up a whole lot faster if it's going to continue to be an American dream and not just a pipe dream to own houses there. Anyways, that was a long one. I kind of rambled on that one. I just thought that was fascinating. Like, you put it into hours worked and you're like, ooh, how bad do you want a house? That's a little crazy. All right, new highs and lows for the day. 75 new highs. Only 25% of them happened to stay positive for the day. Can you guess which stocks they were? They were all consumer staple stocks. And actually, the number's 21% now. So consumer staple stocks, those were the only ones that hit new highs and were able to stay positive on the day, or some of the other ones. Like I mentioned, Altria already. I'll throw in General Mills in there because that did stay at highs. And Kellogg, they make cereal, right? So it's one of those areas where, like, well, who's investing in that? We don't normally look at that. But you get the idea, those types of stocks. There were 15 new lows. All of them finished in the red, mostly communication services stocks. A couple other interesting ones. Dow Chemicals in the office trades today. I did put that on as a short. Equity real estate, obviously, is a REIT. That broke out to new highs. Thought that was interesting, maybe for a watch list. Bristol Myers, looking at this drug company here, looking at possible breakout there. So if you're adding that to a watch list, that was all right. Iron Mountain broke to new highs as well. And remember, this is the one I shorted it somewhere in here. And after some time passed, I said, oh, that don't look good. That looks like it's going to break out. On office trades, I said, let me take a little loss. That proved to be a good exit. So that's always fun to see that. And Warner Brothers. I can't pull it up, I don't think. I cannot pull it up on this one. Anyways, Warner Brothers should come up. Okay, there you go. Warner Brothers hit new lows as well. They were in the news today. Oh, I'd also point out Disney starting to roll off and out of the way there. Some of the other lows, Match.com I already mentioned, rolling away. Etsy's got some problems going on. That's still rolling away. So maybe some other ideas you could take a look at there. Let's go to stocks in the news for the day. I'll take your questions, then I got to roll. You don't want the missus mad at me now, do you? Carvana hitting new lows. Just proof, right, that CarMax gave us the hint there, which is kind of what you saw with the airlines today and yesterday, and same with the rails, by the way. So if you look back, you basically got a 500% rally with Carvana here, and now it's all the way back to new lows prior to the COVID there. Used vehicle sales were off by about 5%, but the revenue was higher overall. Gross profit per car beat by more than double. Total margins were negative, minus 11.6%. Earnings per share, they lost more than 90% what was expected there. 1/3 of all of their sales were wholesale sales, right? So to the wholesale industry there, and no profits in that space there. No bueno. Literally, it is. They were about 1/4 of Wall Street's expectations. So a brutal day for them, down 10%. United Airlines revenue per seat mile up 56%. They still lost 4% or $4 a share. They, like I said yesterday, they said they're going to be profitable the rest of the year with margins of 10% or better, even with lower capacity. Anyways, you go over to American Airlines. They come out today and they're like, here we go. Revenue per reported that they're just basically going to continue where United Airlines left off. It was a lot of the same stuff. They said a lot of the exact same stuff. Record revenue, they're at 90% or 92% capacity, which is more than their competitors over there. And they expect to be at 94% capacity by through Q2, or the second quarter that we're in here. Not bad. AT&T beats on earnings really thanks to subscriber growth, right? They got all the subscribers, up 4% on the day. And Union Pacific reported it was kind of a wild day for a railroad there. They beat thanks to their revenue per carload, just like we talked about yesterday with CVX. They had less car loads, but their revenue per carload was higher. So they did less work, pulled less cars, but they were able to make more money off of it. So good news for them. Weekday for railroads all across the board. And I think I just said CVX. I didn't mean to say that. I meant to say CNP. Sorry about that. And yeah, that did it. So tried to talk a little faster. You may have to slow these things down for me today, but that's what we're working with there. I'll take any questions if you happen to have any, and then get out of the way. I saw Jets come up a lot today. Yeah, so the question is on Jets. So that's an ETF that carries the airlines there. There's just not a lot of airlines in jets. So it's kind of weird to say, well, let me go buy this ETF and let these people go buy the airline stocks for me. You could just do you do it. There's only so many airlines, right? And if you probably don't like certain ones, you can leave them out and stuff. So I typically don't look at jets because there's a limited number of participants in that ETF. Yeah. With an increase in interest rates, do you see REITs doing better or worse? You would think there'd be a little pressure here. In the real estate space, it's kind of like the S&P. You know how we say there's 5 or 6 stocks, maybe 7 stocks that can really move the market because they have such a big share. Well, in the real estate space, say there's like 48 different companies. Well, the ones that are more heavily weighted right now, those are not traditional real estate stocks. They're called digital real estate stocks, which means they're investment trusts that are focused on leasing out server space, leasing out warehouses that then will house servers to then lease out server space, right? A lot of that stuff going on. And so because of that, when you look at the sector's actually done quite well because that part of the space is just booming right now. Supply chain issues, they can't get enough of this stuff to make more servers, which causes prices to go up, which causes profits to go up, at least for the moment. Yep. Good discussion today about international sales. Consumer sales starting 20 Unilever with a lot of international sales is weak. Yeah, you can look it up. I mean, like if there's a particular stock, you can look and see, like you just mentioned Unilever. Let me see if I can find it fast enough for you. I may not be able to get it fast enough. Oops. I don't want to, I'm not going to be able to pull it up fast enough for you. But yeah, you can look that stuff up to see. And now you know that's what's going on there. Yep. Thoughts on why Twitter is holding so strong? Social media went down today. Is the god of Elon Musk going to come along and be able to buy the company? It's a news-driven stock right now. When you recommend a sector or a stock, what kind of time frame do you typically have in mind for a return? I don't make recommendations like that publicly, not allowed to, get in a lot of trouble there. But what I do is try to point out where money is moving, what's starting to perk up, what's looking weak. That way it doesn't matter. If you're an investor, you go, oh, I was thinking about buying a little bit anyways, right? Maybe you're going to start a position. If you're a trader, you know what you're doing, you do your thing there. I just try to point out what's sort of moving for the moment. Yeah. I hear you. You've had jets for 2 years now, seeing it went down 30 with COVID, sideways anytime thumb. Yeah, it's a tough one. I mean, and it's going to be a little bit more volatile because there's not a lot of diversity in there. You know what I mean? That's a tough one when it's made up of so few names. So that's a tough one there. What's the MPG for the F-150? 10 miles a gallon? Oh, I don't know. I probably get that in my truck, but the brand new F-150, they can't do better than that. Yeah. So, Dustin, how about that Roku? You got it? Let's see. It was a bad day for it, right? Roku down 9% on the day with Warner Brothers and all the others, it looks like. Yeah. And Netflix, of course, right? That's what's going on there. I don't know what the question is. You laughing at it? Subject for the wine and wealth tonight. No wine and wealth tonight because I mentioned at the beginning here, I got to take my wife to the airport and, husbandly things. She'll be fine. She'll be fine. What's with the argument on F-150? Does someone have an F-150 or something? Not a bad truck. I don't know what the gas mileage is. I can't know everything. Are you buying semiconductors? No, so I couldn't say either way, but no, I haven't made any adjustments there. In the office trades, we did have some semiconductors. Got super lucky on that last rally and got rid of some of them just because they hit their profit target, not because I thought they were going to go lower or higher or anything. Just got lucky there. Yeah. Cashed in some utilities. All right, there you go. So he saw the boring sector over there, went and made some money, and he's like, all right, let's go do something fun. Well, it's working on it, right? A lot of this tech stuff is just getting, I mean, if a tech stock sells off, let's say Netflix or something, at some point you go, okay, right? You've priced in the next couple years. So is it not a value now, or is it still really beaten down? It's kind of tough. It's like when Tesla gets a little rough for a while. It's like, okay, didn't we just price that all in a matter of seconds and now it's actually a good deal? So you can be careful with some of these. I think some of these are starting to get pretty oversold there. I do live in a free part of America there. Yeah, I'm not familiar with the rest of the world. I hear from friends and stuff, and I'm like, what? I don't. It's truly weird. Like, depending on where you live, what's going on. But no, it's life as usual down here. There you go. You got a friend there, Harry, going all in on Tesla. There you go. You got an F-150, 19 to 23. I don't know if that's good or not, but it's what it is. You guys are car people too. Thoughts on investing in international funds? Careful. Now, international it's a whole different animal. So are you talking about a particular area? Are you talking about building your portfolio out of maybe some Brazil, some China, and things like that? Taiwan, of course. Or are you saying, I want to just pick a random international fund? I'd be careful with that because some of the international funds got real heavy in China and still have yet to change their position there. You don't want to find out you bought an international fund that's 33% in China. Okay, well, we're essentially just playing China here, right? Yep. I like it there. What's your take on commodity producers like the miners? The miners have been on fire there for a while. You look at Newmont, it just got ahead of itself. This is what you got to worry about with some of these really hot sectors or industries right now, like energy. It's the same thing. Really hot, really exciting, but too far, too fast. And it's impossible to pick the top or bottom, right? You guys know that. But you know you're playing with fire if after a 60% move, you're the guy that says, yeah, let's do some of that. So this is what you get from that, a little profit taking. So I'm in that mode of saying, I don't need to guess the bottom here. Let's let it breathe and wiggle around. Everybody can get readjusted again. So I have no commitment to that area right now. Yep. Hey, we got earnings tomorrow still. Don't walk away. American Express, Cliff Natural Resources, HCA, going over to the healthcare space. Newmont, speaking of Newmont. What else do you got? Schlumberger and Verizon, along with a few other smaller names, wrapping up the week there. And we'll see how it goes. In the meantime, I do have to run. I appreciate you guys hanging out with us, and enjoy the rest of different there. I interrupted it.